Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, and I have Mr. Jim Welsh here with us from Macro Tides. Good to see you, Jim. Happy Friday to you, and happy Hurricane Day, I guess.
Yeah, for the first time in a century, Blake, San Diego is going to welcome a hurricane, and it could be what they're suggesting because it strengthened its Hurricane Hillary, strengthened to a Category 4, which is a pretty serious hurricane. By the time it gets up towards San Diego, because the ocean water temperatures are cooler and so forth, it'll still be a Category 1 and potentially still be a Category 1 as it works its way north up to Los Angeles. So, a lot of rain on the eastern edge of the thing. There's, like serious wind, 40 mile an hour to 60 mile an hour wind, which, it's just crazy to be happening. Like I said, the last time it happened was 100 years ago.
Well, Jim, is it that crazy though? Is it? I mean,
you're not going to entice me to go there, buddy.
I had traders from around the globe saying, "Hey, Blake, you're going to be hit with a hurricane this week," and I'm like, "Really?"
What?
But true. I mean, we'll probably have the tropical storm as it makes its way to our. Anyway, no one wants to talk about the weather here. Everybody wants to talk about the markets. And Jim, I have to say, being that I am a subscriber, I get your updates. You sent out an update overnight saying that the stock market, there was a good chance we could, push lower and get a bounce. Lo and behold, here we are on Friday. We're getting a bounce into the end of the week. I know you're going to show the charts, but I think it's important that traders know that not only do you send out your weekly technical reviews, your monthly macro updates, you also send out periodic, on the fly updates at Macro Tides. So
yeah, I mean, I sent it out yesterday before the close, comfortably before the close, and when markets appear to be nearing an inflection point, I try to provide that guidance. And so the guidance was to cover half of the short position that we put on a number of weeks ago. If the S&P traded effectively below 1445, the recommended position was in SH, which is the inverse S&P ETF, to sell at 1432. Sometimes you get lucky, Blake. It opened at 1435.36. And yes, we've had a reversal, and as we'll see, we'll look at some things as to why that seemed to make sense. That the rubber band was stretched enough; it was time to see some kind of a bounce.
Interesting, and so I just want to remind listeners, faithful listeners here, and also new listeners as well, to the Trader Summit interviews with Jim. You get a 20% discount, so make sure you check out Macro Tides.
Yeah, there you go, Jim. Send me an email, jimwelshmacro@gmail.com.
There you go. All right. Well, let's get into like what we want to talk about. I mean, because you brought a bunch of charts, and I need to go grab the list of all the charts that you brought. But let's start off with your first one, which you talk about excess savings and what does this have to do about anything? Americans are obviously they're consuming and they have savings and they're wait a second.
Maybe that's it. I can see it.
Can you see it?
Hopefully everybody else can see it, right?
Yeah. Okay.
No, okay, here's the whole point. All right. And we've talked about this kind of almost endlessly, but it is what it is. A year ago, everybody was looking for a recession. As we talked, no recession. First part of this year, we're going to have a recession. One of the things I cited last year, as well as the first part of this year, is excess savings. During the pandemic, there was windows of times when people couldn't go out. They saved some money. The government sent out a lot of money, a couple $1 trillion to consumers. They saved it. And then as the economy opened up, they've been spending it and drawing those savings down. So at the peak, I think August of 21 was around 2.1 trillion. And now this is from the San Francisco Federal Reserve. And these are estimates. There is no easy way to calculate, what is the precise number of dollars that are in excess savings. Back in March, they said there was about 500 billion. They updated it through June. It's down to about 190 billion. Consumers have been spending about 85 to 90 billion a month. Therefore, before the end of the third quarter, they believe excess savings will be largely drawn down. And again, the point being is consumer spending has surprised people. Well, this is one of the reasons. They had extra money. In addition, consumers refinanced in 2020 and 2021, pulled out $400 billion worth of, if you will, home equity. And because they refinanced, their mortgage rate is way below 7%. They're saving money. So those are two of the reasons why I didn't think there'd be a recession last year, the first half of this year. But I think this is one of the reasons, and one of the things I pointed to. We're likely to see things slow in the third quarter, and then that slowdown accelerate. Well, why is that important? Because this week, everybody's going crazy. Do you see the Atlanta Fed GDP now? It's up to 5.8%. So we've gone from, oh my God, the sky's falling last summer, to, oh my goodness, the economy's unbelievably strong. It's the perfect setup for people to be surprised again by the economy slowing more than they're anticipating. This is just one of the pieces of that puzzle.
And I remember, several months ago, you're like, it's going to be the perfect setup where everybody believes that we have skirted a recession, and there's going to be we could call it a rug pull. I like to use that term, that phrase quite a bit, but that's when you get the oh my gosh, maybe it's not as good as expected. And I do want to remind our listeners that you had been looking for a break higher in the S&P. Above 4,200, you thought we'd reach towards 44. I think we surpassed,
45.20 was my target.
Yeah, we surpassed it. We surpassed it a little bit. And the reasoning why is because people would believe that we're not going to have a recession. But, it's everything's kind of, coming to as you planned, as you mapped out for us, Jim. So I just want to say kudos, but bringing up the next chart, you have the yield gap versus the S&P. So tell us a little bit about this.
Well, 2 weeks ago, in the August 4th, conversation we had, we looked at this chart, and I'm kind of like, wait a second, what we've seen is 10-year yield going higher, and yet the S&P is going higher. And all of last year, the correlation between the two was very tight. And the idea was that last year, as Treasury yields went up, PE got compressed on the market. But in June and July, that didn't happen. Well, there were two reasons. In June, artificial intelligence, kind of went nuts, the mega cap stocks. Yep. And then, of course, the idea that, hey, we're not going to have a recession. Oh, we're really not going to have a recession. Earnings are going to be great. But that gap was so wide, I thought if Treasury yields pushed higher, and they have, that it would cause the S&P some consternation, which we've seen over the last 2 weeks. So this was just like, hey, folks, 2 weeks ago, this is what we were talking about. And, as it's fortunately transpired, we've seen Treasury yields push higher. The S&P has gone from 4,600 to, 4,335 in 2 weeks. So, this, again, trying to show how things are correlated. When the Bank of Japan increased the 10-year target yield for Japanese bonds from 0.5 to 1%. That was one of the reasons we talked, again, 2 weeks ago, that Treasury yields, that was a negative for Treasury yields. They would likely go up. Then, of course, we got, the Treasury issuing more bonds. We got an inflation report that we talked about. Hey, it's going to tick higher on the headline. It did. So a lot of things have come together to push yields higher. And they've ultimately now, are pushing, hitting the market.
Yeah. Yeah. Well, that's happening right now. And I know you've got a chart to here in just a little bit. We're going to go over what you think yields are going to do, because obviously the bond market is sold off. And that I would say is the one situation that you didn't foresee coming at the time. But yields have rallied, and I'm interested to get your views when we get there. So make sure you all stick around for that. This next chart is the S&P is oversold. And what did you see here that really kind of prompted you to alert your subscribers?
It was a combination. Yeah, it was a combination of things. You can see, and again, I sent this out yesterday morning, and the breadth was pretty negative. So that black horizontal line you can kind of see is oversold, and the market effectively, this is a 21-day oscillator of net advances minus declines as a percent of the issues traded. All right, that's the math behind it. And you can see in March, it got down to this black line. Last September, October got, below it. So no, it's just making the point of, hey, the market is sold off. A lot of stocks have gotten hit pretty hard, and breadth has gotten pretty negative. And if you look at the top part of the panel, you can see the high last August was 43.25. There was a low in late June at 43.28. So my expectation was, hey, I think there's a shot that we could drop down near those numbers. And if that happens, it'd be wise to sell into. In other words, cover half of the short position, being able to do it into weakness. And as I said earlier, sometimes you can do all this happy stuff, and sometimes luck plays into it. And as it turned out, we got a little lucky. The market gapped down this morning. The S&P traded down to 43.35. SH opened at 14.35 to 36. So, and now we're getting that bounce. But I don't think the selling wave is done yet.
Well, Jim, I think first of all, it's a great call, but great insights, especially as you go through, the mechanics of how the market even gapped, and that was your opportunity. Making calls is one thing, but when you can trade it and effectively, execute a plan based on that, that shows us a lot, Jim. So great job.
Well, thanks. Like I said, sometimes you get a little lucky too, and
Yeah,
the gap down this morning, it's like, but, the chart was suggesting that there was a decent chance that we'd see the S&P drop below 43.45, approach those levels. So, this is where the technical analysis part is indispensable, in my opinion, in conjunction with, the fundamental view of, hey, I think yields are going higher. That's going to pressure mega cap stocks if they get hit. And then 2 weeks ago, I showed you a chart of the Russell 2000. He said, what are you showing this for? Well, because there was this trend line, and that was part of the, we're not going to have a recession. The Russell had a big bounce. The regional banks rallied strongly. It's like, hey, if the Russell breaks down, that's telling us something in terms of the overall market. And of course, the Russell a week and a half ago did, in fact, break down. But anyway, why
it's great putting it all together, Jim, and I'll tell you that's really, really key support that we're on, and but it's to be seen if it's going to hold or not. And I think there's a lot more to it, which we're going to get into. But one of the charts you brought up here is the semiconductor ETF. Why is this one so important to you?
Well, as we all know, mega cap stocks have been very strong, and then part of the AI story has been computer chips, with NVIDIA being, the poster child for that. So, again, what I look for is when markets move and you see a 5-wave impulse move, that typically tells you that you're going to see that the direction of that is going to continue for a little bit. So in this case, it looks pretty clear to me. You can count 1, 2, 3, 4, 5 down. This is the semiconductor ETF SMH, and 5 down. Well, what it also says, we're going to get a bounce. You get a 5-wave move in any direction, you're going to get a counter trend move. And what this, just as a guesstimate, 151 was the high of wave 4. The 50% retracement is 152. So to me, there's the potential that, okay, this is going to get a bounce, where that ties into the overall market outlook. But this 5-wave down is either wave A of a bigger correction. So you get a B wave bounce up to 150, 152, and then we're likely to see another leg down to take us lower, and then you complete the correction. The alternate count, which is far more bearish, is it's 1, 2, 3, 4, 5 of wave 1 of a much larger correction. You're going to get a wave 2 bounce, and then you're going to get a wave 3 that is going to be pretty nasty. There's no way of knowing at this point in time with any degree of certainty other than we're going to get a bounce. When that bounce is over, we're going to see another leg down.
Yeah.
So that to me is the most important information is like, all right, let's put it in the framework. And if indeed we get that bounce and then we start to head lower, the magnitude of that sell-off will tell us, hey, is it wave 3 or is it wave C? And then we're going to see another much bigger rally, subsequently. There's just no way of knowing other than we were going to get a correction. To me, short term, there's things that have come together to suggest we're going to get a bounce. I think the odds are, based on this pattern, that we're going to see another leg down before the market's going to be in a position to rally in a more sustainable fashion. And that's the optimistic view.
Got it. Well, that's the optimistic view, and that's the key point here. All right, so let's talk a little bit about yields because, like I said, bond markets played a little bit of a trick on us. We've had this pretty good selling, even in the face of, the stock market looking a little wobbly, but yields are at levels. It doesn't matter what end of the curve you're looking at; they're pretty damn attractive. So, do you think they're going to become more attractive?
Well, the thing we talked about, this is going back probably 3 weeks ago. You can see the red downtrend line.
Yeah.
And what I talked about was that you had a pop above it. Then the yield tried to get down below it. It was rejected. And then we saw the next leg up. So my take was, unless you take out that trend line, we're going higher on treasury yields. And that was my bias. And then with the Bank of Japan, the conviction level went up. I was pretty confident we would see the CPI tick higher based on mathematics of what we were taking away 12 months ago and so forth. So to me, this uptick in treasury yields, was foreshadowed by what the technical action was. And then the fundamentals kind of filled in the blanks to allow this. Now, the thing I'll point out is the high last October was 4.333. It got to 4.325. All right. You got to be thinking, is it a top possible for a double top? If not already in place, there may be another push higher, but you hang out there. The bottom panel shows the relative strength of yields. And what we can see is, to your point, they've made a pretty big move to the upside. The RSI got to 70, and the black arrows show the other times, obviously, when it got to 70. So, to me, this implies that we're going to see treasury yields come down. In fact, in my last Monday's weekly technical review, I gave a recommendation on TLT because my thought has been is we're going to get close to those yields of last October. But since I still think we're going to see the economy slow more than people expect, that treasury yields have the potential over the next 6 months or so to come down. So the recommendation was to buy TLT at 93.60, a partial position, because, hey, we're stepping into something that's been pretty weak. But that's the bigger framework that I think potentially we're nearing a high in treasury yields. But technically, we don't have any solid evidence that in fact, the turn has been made.
Could be a double top. And I know a lot of people like to say this, but double tops make stops. So,
Yep, they do. And that's why potentially can you get a spike above that level from last October? And then it comes down to the tell will be you spike above it and then you get back down below it pretty quickly, because that gets to your point. People got a bunch of stops above 433.3 and they get hit, you clean them out. And then all of a sudden that's the end of the selling and boom, you come back down. So, hey, I just think we're at a point where yields have made a heck of a move in a relatively short period of time. They're likely to work their way lower, at least temporarily.
Yeah.
And then it comes down to what happens if they have another push. As I said, that black trend line is at about 411. That would be, again, a constructive point that the 10-year, after breaking above that, is able to get down below that. Ultimately, the red trend line is going to be the final piece in terms of, we've seen a top if the 10-year can drop below that. That's all out in the future.
Yeah, that is. All right, Jim. Well, the next chart you brought the dollar. So what do we
Yeah.
do with the dollar here? Because it's rallied quite sharply, and what do you do?
Well, a month ago, we were talking. It's like, all right, there's some reasons, positioning, big short positions in the dollar. There were articles a month ago. Oh my God, it's going to lose its reserve status and all the rest of that. And to me, the price pattern, first of all, when it was up around 103 or so, like I think we're going to go down and make a lower low. You have a triangle pattern. So technically, this has followed that script pretty well. And then the expectation was 103.50 to 104. They got to 103.68. The RSI is almost overbought. I think it was 68. So a pullback at these levels makes some sense. Again, my take is that at this point in time, it's the right place to be flat. In other words, if you went long a month ago and you got to these price targets, okay, because I have no idea for certain what's going to happen. Well, I never know for certain, but pullback seems likely under 102. I think that number is. The dollar, let's say Powell talks next week at Jackson Hole, and he doesn't give the hope that the Fed's about to turn or back off, or the dollar would strengthen, I think, on that news. So that trend line, that black trend line, getting below that and staying below that will be a tell that, okay, maybe this is all she wrote. But I haven't given Powell's speech next Friday enough thought. I'll cover it in Monday's weekly technical review. I think it's going to be more nuanced, than it was last August. I think he's talking about global structural things, which is almost like, who chose that? Did he purposely choose a topic that won't specifically target U.S. monetary policy? It's more like, well, demographics are this and blah, blah, blah. I don't know. Like I said, I got to put my thinking cap on, and I haven't had a chance to do that yet.
Well, we'll be waiting with bated breath, and I think
bated. What is bated breath actually? What is that? Does that
I don't know. I'm gonna Google that right now. But I do want to say though, from like the meeting minutes that we got this week, it does suggest that a majority of the Federal Reserve members and governors would rather make sure this job is done. And so it's going to be interesting if Fed Chair Powell reiterates that message, because the market might take note of that as we go into next week.
It's a great point. And again, look at the economic data that has come out since then. On balance, it's far stronger than I think most. I mean, it already was far stronger than people thought when they had their last meeting. 3 weeks ago, and it's come in showing even more strength. So those who are like in favor of raising rates, will point to that. That's why I think Powell has to leave on the table additional rate hikes, which I think is the point you're bringing up. Whether or not they go in September is almost beside the point. It's like, okay, the bias is we're going to finish the job, which is something that he has, repeatedly said over the last year.
Sure.
So again, that would be a tailwind for the dollar to the extent that he in fact covers those points and does it in that fashion.
All right. Well, the last chart you brought up is gold, and gold has been really underperforming. We're still flirting with some really key support here. I mean, what do you do if you're a gold bull? I mean, and I'm going to sit here and tell you, and Jim, I know what you're going to say technically, because I'm with you every week, so I think I got your views here. But I mean, I'm a gold bull too. But if I'm a gold bull, I'm not feeling great today. So, and I'm not feeling great this week. So, what do you have to say about that?
Well, again, the technical pattern was you had 5 up into the high in early May. All right. Longer term, that's a pretty big message. All right. It's saying that after any pullback, there's going to be another push higher that'll take out those highs. And in this case, that means going to new all-time highs. But the 5 up meant we were going to get a wave 2 pullback. And it's kind of been grinding lower. The gold went up 30 weeks. So if you say, okay, what's a 382 of 30 weeks? Well, that's like, 11 weeks. Gold peaked in the first week of May. So we're at about the 382 retracement. Can it extend a little bit more? Of course. The pattern looks like an A down, a B up. And if A and C are equal, I think that gets us down to what, 1822 or something like that. The 50% retracement is 1837. So the take has been, we're likely to see a drop below the low that was reached in June at 1892-ish or whatever. And I still think that that's the likely course, that we'll see this happen. I'm assuming that if, you know, gold gets much $10 or so below 1894, it'll start hitting some stops. So to me, under 1850 seems likely. And, you know, again, I think that this weakness should be used, since it's been anticipated, to look for an entry place to go long. All right. And again, take partial positions and so forth. So the idea in my mind is, you get down to under 1840, that would be the place to start to consider putting some money to work. The RSI, the bottom panel, shows it's down to 30. So, you know, again, I just think there's this, with gold, a lot of times that last move, you know, it could be down 1%. It could be down $25 one day. Oh my God. That's usually the time when you've seen this pattern develop as far as it has. That kind of a one-day decline often happens at the end of a move in gold, both to the upside and the downside, where you get a boom, this big spike up, like in early May. Look at that. You had 2-3 day rally that jumped fairly significantly.
Yeah.
I think potentially the low gets put in with something, you know, kind of
like a V bottom, or a, you know, kind of a shakeout. And this is where, Jim, your years of wisdom should be noted, and traders that haven't been around as long as Jim, you know, should be thinking about what he has to say. Yeah, that's right.
Well, thank you. You've been very generous with your kind comments, Blake. I mean, I love doing this stuff. To me, it's so interesting to try to put all the pieces together, and it feels pretty good when they do fall into place. And then the markets are kind enough to actually follow the script to some extent.
All right. Well, Jim, what's the best way for us to follow your work?
macrotides.com, or if you want me to send you something quickly, Jim Welsh Macro at Gmail.
Jim Welsh Macro at Gmail. So guys and gals, if you've enjoyed your time here with Jim, like I have, make sure you give him a big thumbs up, subscribe to the channel down below so you don't miss any of this exclusive content, and comment down below if you have anything that you want to mention to Jim, and he'll be checking out those comments. So guys, gals, have a great one. Jim, good luck with this with this hurricane that's coming your way.
I'm kind of excited, as long as no damage is, you know, that not a whole lot of bad stuff happens, just a lot of rain and some wind. You know, it's kind of, it'll be cool. You know.
Oh,
well, thanks.
Yeah, good luck. Good luck. All right, we'll see you next week.
All right, you got it, Blake. Thank you.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.